Hello investors, it's September 19th, time for our market update. I'm Adam.
I'm Grant.
We've got Gary behind the camera and we are Dynamic Wealth Management. Summer's coming to an end, kids are getting back into school, snowbirds are coming home, football season started up, and we got the Fed meeting tomorrow and Wednesday. We get an answer on Wednesday.
Yes, we do. The market has been a little bit scary lately. We had really all-time highs recently. It has now fallen down to a resistance level. We're going to see what the Fed says on Wednesday, and that's going to make a big move for us. So we'll jump in the charts and show you what we're talking about.
All right, again, we are Dynamic Wealth Management, and this is our September 19th, 2016 update. Before we do the actual update, just want to update you on some upcoming events. We've had our summer hiatus. Many of our clients have been gone for the summer. People are starting to return now. Snowbirds are coming back. And so we're starting back up our investments for breakfast. We do that every other week. And our first one of the season will be October 4th at 9 a.m. at our office, in our conference room at 14780 West Mountain View Boulevard. That's in Surprise. We're on the second floor, Suite 211. We do that at 9 o'clock in the morning. We provide coffee and Danish and some fruit juice and fruits and water and so forth. It's an informal. For those if you've not yet attended one of our investments for breakfast, we welcome you to come. It's informal. It's a great chance to get to meet us, to ask questions, to make comments, and to learn. So it's an open format discussion. We will share some slides of interest to explain what's going on in the markets and certain strategies and things like that we'll cover. If you'd like to get to know us in more depth, you can come to our investment seminars, which we will announce next time, and those will be beginning also in October. And that's what you need to call to reserve your seat for, okay? You don't need to call and reserve a seat for investments for breakfast. Just got to show up. So Tuesday, October 4th. So what we want to first talk about is our risk indicator. As you know, this is what we use to determine how aggressively or defensively invested our models are in our core ETF model. So that ETF model has a bullish phase, a neutral, and a bearish. So in the bullish phase, we'll be fully invested for the model. And if we cross over into the neutral zone, then we reduce risk. We go more defensive. If we get into the bearish red zone, we will be fully in cash and defensive investments to wait out a market correction. So again, as it stands right now, we're still in the bullish zone, even though the market's dropped about 3% since the high point in September. The month of August was relatively flat after a strong July. So August was flat. We got a little up the first few days of September, but then a big downdraft. Well, big in relative terms, 3% was quite big because the market really had stayed in a very tight range for over a month, and so it broke out of that range to the downside, but it has not yet crossed into our neutral zone. So we're still fully invested for each of the models that are in the ETF model regime. So what are some key events that are either happening or have happened that are affecting this? Well, since we hold our assets for our clients at TD Ameritrade, we thought we'd start using their week highlights. And so, the first one here, they note that market volatility has picked up after the post-Brexit summer slumber. We've had very low volatility, as I mentioned a moment ago, where the market just stayed in a very tight range. And then, as he says here, hawkish statements by Fed presidents were trumped later by Governor Lael Brainard's speech, convincing the market the Fed will wait until December 1st next rate hike. Interestingly, what harpooned the market and caused this big sell-off, where it dropped 3% in the last week, was Lael Brainard being put on the agenda to speak. Lael Brainard is the most defensive member of the Federal Reserve Open Market Committee as a voting member. She is the one who has been in favor of keeping rates where they are and not raising rates, and is the one who insists that we need to have more information and she's the most dovish, meaning she doesn't really think we should be raising rates just yet. And so when she was out of the blue, scheduled all of a sudden to appear and speak last Monday, that freaked the markets out. They thought, okay, Federal Reserve is going to be making a decision this month on interest rates, and now they're having their most dovish member speak that was unscheduled. She must be saying that she's now capitulating and thinks we should raise rates. And the market assumed the worst, and bonds and stocks got hit pretty hard. And then she spoke, and her speech was not at all what the market expected. She was saying, yeah, I want to see proof. I'm not convinced the market is the data is there consistent to raise rates. And so that significantly weakened the expectation for a rate increase for the month of September, which will be decided in a couple of days. So the Federal Open Market Committee, FOMC, meets tomorrow and Wednesday, and then Wednesday afternoon, Janet Yellen will make the announcement, and then she will follow that up by commentary on the decision. Our expectation is that rates will not be raised. We've been holding to that expectation for quite some time. However, whether we think the rates will raise or not doesn't affect necessarily our ETF model. That has its own rules, and those rules are governed by the movement of the market. And as I mentioned previously, the movements we've seen recently were not enough to move it out of the green zone. While global economic data is showing some pickup of growth in the second half of the year, the market has been quite fragile. There's been a lot of disappointment, and actually a lot of the economic data this week that came out was weaker than expected, and actually made it so that it was less likely still that the Fed would raise interest rates. So if they do raise interest rates on Wednesday, it will be quite a shock to the market. We'll be interested to see how the Federal Reserve responds, and at that point we'll also probably do another commentary to follow up on this one. So looking at again the rate decision, the expectation from TD Ameritrade is that the policy statement should contain a neutral assessment of risk, and they also think the Fed will remain on the sidelines and not change interest rates until at the earliest December. And so after this, of course, we'll hear all sorts of talk again about rates rising, but until the economy really heats up, we don't think that's likely to happen. Here's interesting in history. You can see how rates rose, tapered off, and then dramatically fell. And then people have been waiting for this jump back higher that just hasn't happened. It's remained relatively flat, well, basically exactly flat now for a long period of time, and they keep talking about normalizing rates. Well, they did raise it a 0.25% in December, and nothing since then, which is exactly what we said we expected back at the beginning of the year when they first raised rates and freaked the market out then. Looking at different Federal Reserve chairmen's periods that they served, you can see during their tenure what's happened with each one of them. And interest rates, again, here's Bernanke. They flattened out, dropped, and have stayed down here. And they talk about normalizing. I don't know that there is a normalizing anymore with all of the things they've done with money supply and everything. It's an unusual situation that we find ourselves in. So this next slide is one that Gary worked on, and it really has to do with the questions that we start getting this time of year about, what's going to happen to the stock market based on who wins the election. And you'll notice here that Obama market did well because why? Not because of Obama, but because the Federal Reserve was stimulating the economy. In the Bush years, the economy didn't do so well. Clinton did well, but then the prior Reagan, we had great years. So is it really about Democrats and Republicans? No. It has much more to do with what the Federal Reserve is doing. It has to do with some of the fiscal policies, and that includes not just the president, but also the Congress. So as far as, should we be rethinking our investment strategies and so forth, we really don't do it that way. We're not basing our investment choices based off of which party wins the presidency. Here's another one showing you what's happened in election years as we're running up to the election, and this is as of June, but so that's for this year, it's as of June. But you can see also not terribly conclusive, although I will say the market's been positive many more times than it's been negative, with really the only big negative shock happening during the year that the Democratic president was elected. Maybe that had something to do with it. It's the economy, stupid. I don't know. No, I guess that was back in Clinton's time. So anyway, that's again, not terribly conclusive one way or the other. We're not going to use it to make decisions on how to invest. I would say if there is one asset class that probably everyone agrees that would do well, or one sector that would do well, whether we have a Republican or Democrat, it's defense, spending on defense. And not surprisingly, defensive stocks have performed fairly well this year. And so aerospace defense has done quite well. That's really all we have to say about that. Grant's going to go ahead and talk then more about what's going on in the charts, and then he'll also go over our sector model as well as the allocations as they stand right now for our core ETF model.
All right, let's jump into the stock market. And first I want to talk about the volatility that we were talking about earlier. So here is 2016. Now this green line represents how volatile the market was in those months. So January and February, very volatile. This was the worst start to a stock market year that we've had almost in history. It was a terrible start to the year. Then things calmed down, and you'll see this green line comes down, meaning the market was less volatile for a while. We had a big spike here in July. This was the Brexit that spiked, and then market calmed down again. And now we're spiking again. The Fed is getting ready to come out with a statement on Wednesday that could really move the markets. So the market's getting a little volatile in anticipation of that. Also, the market's been at all-time highs recently. Excuse me. We're getting a little drop off from that, and that's kind of why we're seeing this volatility spike. So here's an actual chart of the S&P 500, and here is where the year started. So again, January, big drop off. Tried to climb back, another big drop off into February. And then it rallied strong and got break even, right about here, and then has actually gone positive, even to all-time highs recently at 2193 on the S&P 500. Now you'll notice, you'll notice over the last week and a half or so, we've had this big drop off. Now, is that bad news? Maybe not. It's pulled back to a resistance area. So we kind of are thinking this is at least a short-term opportunity here. I think we're more inclined to buy here than to sell here. But we'll get more into that, and I'll talk about our allocations here in just a minute. Another reason why it's looking good, at least on the short term, is this is the McClellan oscillator, and you'll notice when it comes down and touches beneath this lower level, it's usually a good time to buy. This is the S&P 500 down here. So when the McClellan oscillator comes down, if you would have bought, well, it would have been a good time. And the McClellan oscillator recently, if you would have bought, it would have been good. If you would have bought, it would have been good. If you would have bought, it would have been good. And look, we hit that lower level again just recently, and now it's moving the other way. So the McClellan oscillator is showing us, at least on a short-term basis, this is a good buy spot right here. Here is year-to-date performance. U.S. stocks have gone up about 4.6% year-to-date. We don't have any international exposure in any of our models currently. You'll notice the only two things that are down here are the two international indices. So here's international developed stocks, here's emerging markets, and both of them are down close to 3%. There's been a trend for a long time that the U.S. has outperformed international, and so we've jumped on that trend, and all of our holdings are U.S. based. So the trend continues, and we're benefiting from that. Real estate up about 9.5% year to date. High yield bonds up over 11%. Commodities up 8%. Gold up 23%. Gold is one of our holdings in the sector rotation model, so we love to see gold do well. Short-term treasuries up 6.5%, and long-term treasuries up about 13.5%. These are big holdings in our core ETF model, so we like to see them do well also. Overall performance is good. I mean, really, international is the only thing suffering. Other than that, we're looking up across the board year to date, so we'll take that. What are our current allocations? Well, we are in the green zone, and we have a little bit of room up here. We're gonna let this breathe a little bit. We're gonna let it move, and unless it drops beneath this yellow level here, we're not gonna make any changes. So we're gonna let this come back to us a little bit. Hopefully it'll bounce and continue upward. If it does not, if it breaks down hard, then of course we will take action to protect our clients as soon as we're into the yellow zone. What does the green zone mean? It means that if you are a growth client, you're 100% in the stock market at this point. No defensive holdings. If you're a moderate client, well, you're 80% on the equity stock side of things, 20% on the defensive bond side of things. And if you're conservative, you're at a 60% equity, 40% defensive. This is our current holding if you have any of our ETF core model in your portfolio. Real quickly, we do just want to mention that our holdings are the same for our sector rotation model. These green sectors are the sectors that we're holding right now. And again, just to kind of recap, we covered it in previous video, but the first thing that we do is we have these 16 sectors, and the first screen that we run is we say how many of them are above their 6-month moving average, and the ones that are not we exclude, and those are the gray ones. So these ones that are gray, they weren't even eligible to be one of our holdings because they were beneath their 6-month moving average. So once we exclude those, well, now in this case we had 13 that were eligible, and we ranked those 13, and we ended up with our top 8, and we took our top 8 positions. So you can understand the idea of this. The idea is to stay out of the bottom half of the market that's underperforming and not doing well, and to only hold kind of the better half of the market, the best sectors that are moving our way. And you'll notice that like a lot of these recently, utilities, real estate, gold, year to date, these are things that have trended and have stayed on top. So we grab onto these sectors, we overweight them, and we hold them for a quarter at a time. We'll be changing up this allocation on October 1st. Okay, thank you so much for watching our video. We want to disclose that we are not recommending that you buy or sell anything based on this video alone. You should always consult with a financial professional before you make any big decisions. We are simply giving an update on the market and educating. Thank you so much for watching our video. If you have any questions or comments, please contact us. You can email us, you can contact us through our website, or you can call us here at the office. Thank you so much for watching. Have a great day.